Ladies and gentlemen, thank you for joining me. This is Christopher Aaron coming to you on Sunday evening, December 20th. It's our weekend gold and silver update, taking a look at the last half of the week and putting this in perspective. I believe we're in a really critical time in these markets. There is a massive transfer of wealth that is going to be happening over the course of the rest of our lives. And I think it's vitally important that we pay attention to both the short term so that we can time our purchases better and the long term so that we not lose sight of the really historic trends that are developing in these markets. So it is my endeavor to bring you just the clearest analysis on what is actually happening in the markets so that we can filter out some of the emotional rhetoric that appears in other forms of media. Thank you for joining me, anyone who's new, and thank you for joining me, those people who have been with me. We are going to be looking at the 3-day post-Fed action for gold and silver and related assets. Now, we looked at this slide for 1 day last time on Wednesday. This is 3 days, and I'm going to make my video really small so we have no problems with seeing this here, but just know I'm still with you. So we're looking at the 3 days since the Fed meeting, since the historic rate rise. And you can see we are talking about 6 major world asset classes here. We're talking about silver, US bonds, greater than 20 years in maturity. We're talking about gold, the US dollar. We were talking about commodities as a whole, and we are talking about U.S. stocks represented by the S&P 500. And what I've done here is very simply just plot these 6 asset classes, these 6 major world asset classes on the same scale over the course of the last 3 days. Now, guys, this is really important because you are seeing a shift in these markets right in front of your eyes. And it's these subtle shifts that lead to the bottoms that we're talking about over time. So look at what happened here. We had silver leading on Wednesday and then falling back down on Thursday and then rising again on Friday to lead the week, to finish the week ahead of all these different asset classes. What other asset classes came in after silver? We had 20-year bonds, we had gold, and we had the US dollar. All finishing silver 2.4% higher, US bonds 1.4, gold and the US dollar just around 0.5% higher. Now, look at what happened here in these markets. 20-year bonds, gold, and the dollar are all safety assets. These are flight to safety assets. And the converse of that is commodities and US stocks, which are typically viewed as economic growth assets. So look what happened in the 3 days after the Fed meeting is that economic growth assets fell and safety assets all rose. Now here's the critical outlier. Silver. We've all seen that over the last 4 or 5 years, silver has seemed to fall on days when commodities have been falling. And it seemed to fall on days when the stock market has been falling. It seemed like silver couldn't catch a break, right, over the last 5 years. Look at what happened in the last 3 days. Silver not only went higher, but it went higher on days where commodities and stocks were moving lower. Now, granted, yes, this is still a 3-day trend that we're talking about, but this is the kind of subtle shift that's happening inside the market that I've been talking about that I am seeing play in these longer term charts. And these would be the fundamental shifts in money that are happening. So as the Fed raised interest rates, which means that it sold short-term bonds, other safety asset classes were being bought. Silver led the way. Okay. There's some important things happening in the markets here. And as you know, I like to focus on charts. I like to explain them. because charts can be a little bit misleading. There's 1,000 ways to annotate and interpret charts, and I like to make things as clear as I possibly can. So this is the thesis for precious metals that I subscribe to, that I'm proposing. We're going to look at this a little bit differently. We're going to start wide, and we're going to zoom right in for anyone who is new, all in this same slide. We're talking about this 35-year move in the price of gold, consolidating for 30 years underneath the 850 level, breaking out, and then coming back down into the vicinity of that 850 breakout. We are approaching that vicinity now. Let's zoom in. Looking at that over the 15-year time frame, same chart, gold. We are talking about that green dot is now shown in this green band here. And we have 1, 2, 3, 4, 5 important technical indicators coming in this zone. So I've been expecting for a long time the final low for gold to be in this zone, and we are just approaching it now. So this low could be developing any time in the next couple weeks to several months, possibly a year, but probably not too much longer than that. Zooming in again, gold, 7 years. Okay, we're now getting a clearer picture on what is actually happening to bring this low in that I keep talking about. Let's bring up our key. We had a rise out of the crash of 2009 and a back and forth decline that has been forming this nice trend channel here shown in blue. Just having hit our 50% bull market Fibonacci retracement level, which would be, again, a very important level for a low to begin to develop. We are seeing here on the bottom gold versus the CRB index. We're looking at that outperformance in gold versus all the commodities, even as the price has been moving lower. It hasn't been moving as low as other commodities. Zooming in again to that blue channel, here it is. Look at the number of beautiful hits on this channel. 1, 1, 2, 2, a third on the upper, a fourth on the upper, a third on the lower, a fourth, a fifth on the lower. So this is a really well-defined channel here, and at some point we are going to have the next rise to challenge the upper level of this channel. That's probably the next move to come over the next several months. Now, the low will not be confirmed until this channel breaks out. That's why we're following this so closely. There's our key again. Zooming in again to the 6-month time frame. We're looking at that low, that most recent low below the July lows. Now let's look at the corresponding action in the gold mining index, as we always do, and we're still seeing the relative strength in the gold miners above the July lows. That is holding. So that is another clue that we are getting closer to some sort of a significant bottom. Let's look at the 3 days here. Zooming in, the final magnification that we will do. And we could see the moderate strength that happened on Wednesday, followed by another decline on Thursday, right back down to that 1048 level, and then a rise into Friday, closing at 1066. Okay, so some modest strength on Friday, nothing to write home about yet. Let's move it all the way back out. Let's not lose track of what we're talking about here. One more time, the thesis for gold is that we are approaching, as we're watching this close action from a couple days, we are approaching the final low in the gold market. What is gold doing? Gold is acting as a thermometer. It is letting us know this rise that we saw over the last 10 years was telling us something. And notice, so even as the economy, quote unquote, has gotten better in the last few years, as shown by the stock market going back up, gold has not fallen all the way back down. And in fact, it looks like it's going to stop falling here in this zone. So this rise, we're really looking at this as an indicator. Gold is like an indicator. It tells you when something is up. And oftentimes you'll have the move first, and then the events will become clear. Let's look at silver, a related but not exactly the same thesis. Silver falling to this long-term uptrend line, as shown in magenta, this linear uptrend line, after 1, 2, 3, 4 spikes in price over the last 10 years. The next spike should be a retest of the $50 level, which will eventually be exceeded. However, that's a number of years down the road. So we don't really need to worry about that right now. I'm not predicting that anytime soon. This could be 3, 5, or more years down the road. This entire low forming, representing probably the last significant opportunity to buy silver in the low teens, perhaps ever again. Let's zoom this in. Silver, 5 years. Okay, we are seeing the downtrend lines breaking, represented by this turquoise color. We've been watching this bottoming pattern. This is another thing that lets me know that silver is approaching a bottom. And when this breaks, we will have some back and forth action before the next rise begins, as I mentioned in the last slide. Here again down below, we're looking at silver versus the CRB commodity index, and we're seeing that it has broken the downtrend. So that's, for example, what we looked at in the very first slide, silver outperforming the rest of the commodities over the last few days. We are just starting to see that confirmed on our longer term charts. Zooming in 3 years on silver, and we can see 1, 2, 3, 4 hits on this lower side, 1, 2, 3, 4 hits on this upper side, and this, ladies and gentlemen, is a bottoming wedge pattern. When this pattern forms after a long decline, like we've seen, it represents a bottom based on all my study of patterns in different markets over different time frames. So the bottom may not be in yet. There may be some more grinding, and perhaps silver could even get down into the low 13s, maybe into the 12s over the course of the next several months. But as long as this pattern holds here, this is going to break at some point to the upside, and we will have a strong indication that this was the final low in silver. So there's still some time to accumulate, but it's not forever. It's not going to be another 5 years down at these prices. More like 6 to 12 months at the max. Zooming in again, silver, the last 6 months, and we could just see this low grinding away like this below the August low in silver, a nominal new low, but certainly not collapsing as we've seen in some of the previous declines. Switching over to the silver mining side, just like we looked at for the gold mining side, this is silver Wheaton, and we were looking at this uptrend line here shown in the teal color. It looks like this has broken to the downside. So it sort of tried to recover on Friday, sitting just at that line. We'll see tomorrow on Monday. Was this a false break below this short-term trend line for silver Wheaton, or does it start to fade? Now, if it starts to fade, this is not the end of the world for this bottoming pattern that we've been looking at. It simply means we look for our next support to come in at the lows. So if silver Wheaton were to hold at the lows here in September, and silver was to continue falling, we still have that same outperformance when we're looking at the silver mining complex leading the price of silver, holding for this final low to come in silver. We'll be watching this closely over the next few days. And looking again at the last 3 days, look at that action. So up on Wednesday, red line, boom, back down on Thursday. Friday, no, sorry, coming back up. So that was that strength that we saw on the very first slide in silver. This is showing you that dips are being bought on silver. So you had a dip on Thursday, and buyers stepped right in, didn't even wait 24 hours, and said, we're taking advantage of this. So it's showing you those buyers stepping in here right below $14. A good sign for the future, absolutely. Last time we were looking at silver, the long-term scale once again. This is a log scale, so this is going to look different than the first chart that we looked at for silver. A log scale, meaning a logarithmic scale, this is showing silver as an exponential function. If you look at this y-axis here, you are looking at numbers that are getting closer and closer together, and that is to basically discount the higher moves and give us a zoom in on the lows. So what we're seeing here is that silver is not on a logarithmic upscale. As shown in that first chart of silver, it's on a linear upscale. So that means we're nowhere near the final peak in silver yet. A market that is only increasing on a linear scale is still kind of in the middle innings of its bull market. And I want to make this comparison. If you look at this low forming here on silver and think about gold around 2005, 2006, when gold hit $850 an ounce in 1980, came all the way back down, and in 2005, 2006, I think the first time was 2007, gold hit that $850 an ounce and then backed off a little bit. So my point is this: silver looks very much similar to where gold was around that 2005, 2006, 2007 point, having hit that $50 an ounce level and come back down. So silver is basically lagging gold, if you think about it this way, by about 10 years. It's about 10 years behind gold as far as catching up on the price action. Now, don't let this frustrate you. This is certainly an underperformance on silver thus far. However, an underperformance can also be looked at as an opportunity when we have a sense of where this market will be moving eventually. So it's in that disconnect between where we are right now and where we expect prices to go to at least match gold by breaking above its 1980 high, that there's the opportunity for crystallizing wealth and profiting. So, thank you again for joining me. This has been Christopher Aaron. This was our weekend update, and we will have the next update on Tuesday or Wednesday evening. Thank you again for joining me.